Hey, welcome out, everyone. It's Chris here. Hey, I appreciate you guys coming for this extra special bonus training that we have for you today. Obviously, I'm super excited for this to have Warren on with us, and I'll introduce him in just a minute. Obviously, the purpose of this is because many of you have already been talking about taxes. We're getting to the end of the year. This is something that I feel is pretty urgent, and definitely as I've referred you, I mean, you might have had different CPAs you've been referred to, but some of you I know have been referred to Warren already. And you have this nice little waiting period for about a month. And so I talked to Warren last week and lovely Diana as well, and talked to them both, and was able to convince him to give you guys a special little training here to take kind of book some time out of his schedule to be able to do this. And so these are going to be the commonly asked questions, a lot of the questions you guys might be asking. And for those of you on live, it's this extra special treat because you can ask them questions right here, live and now. And so we'll give some time, just afterwards to be able to do that. But really, I wanted to be able to bring him on because for those of you that know Warren, whether you know him or not, Warren is somebody that I've been referred to for a few years. I actually met him first at a business event where he presented. He was one of the few CPAs I've actually talked to which didn't bore me, and I knew he was a little bit creative, which I love that aspect. At the same time, it was interesting because a few years passed by. I already had some CPAs I was referring to, and then I realized I needed somebody else because some of the CPAs I had, they were getting pretty loaded heavily, and I thought, I need somebody on my team anyways. I need a good, someone who's a great, either one brings a great niche or two is a good backup. And the case with Warren was both. And I remember I went to one of my friends who's, some of you even know him, Ron Phillips, who's a real estate supplier. And I asked him, I said, hey, you did a tax strategy that only I've known, and I've only talked to my clients with the CPAs I've used. You're the only one I've known that's done it on your own. Who taught you that? And his response, Warren Taryle. And I said, dang it, that's the second time I've heard Warren's name in 3 years. So you know what? Let's make this happen. And so for those of you that are meeting Warren here for the first time, one thing I love to refer you guys to him is, especially if you have a business and you have real estate, he's an amazing guy that has experience in both areas there. So in any case, that's what we're going to do. We're going to start bringing on Warren here right now.
All right.
One thing about Warren too is that he actually just got featured on Bigger Pockets, and that's the reason why you guys haven't been able to meet with him, because Bigger Pockets, obviously, when they say, "Hey, here's somebody you should talk to," people listen, and so definitely a huge treat to have you on today, Warren. So thanks for being on.
Well, thanks. Thanks for having me. And yeah, please, y'all who are out there, accept my apologies for the delay. And some of you have called to try to schedule. Uh, like Chris said, we had the perfect storm, right? We just got done with our tax filing deadline, which is always just a craziness here at the tax ranch, as we like to call it, and that and the bigger pockets, and it was just crazy. But if you call, we'll get you in. Let just and you guys have done a good job of this. Just let us know either Chris. We'll put you ahead of those bigger pockets people. But uh, since we know you have a leg up anyway, and you guys already know a little bit about what you're doing, so it makes it easier to help you all out. Uh, so yeah, thanks again for coming in. When we talked, we thought, you know, there's a lot of common questions and things. Maybe we can get a lot of these questions just answered here as a group, and then when we do spend time talking together, we can kind of drill down more one-on-one kind of stuff. And uh, and so if that's acceptable for everybody, we'll kind of get started.
Awesome, let's do it.
So it, Chris has very nicely, generously volunteered to be my clicker for today. So if I say click, it's not that I have a speech impediment or anything. It's Chris is my clicker. So because we all love technology, it's like the greatest thing anywhere in the world. So anyway, we all know this guy on the screen, Ben Franklin, right? And I figured it was around Halloween, so this is a good time to bring up death and taxes because both of those things kind of come to light now, and with Congress and all. Well, we'll get into what Congress is doing in a little bit, but hey, let's try out that click thing. Hey, there we go. So I thought in with Chris and you guys, let's talk about the easiest way there is to become a millionaire. And go ahead and click again. And the easiest way is to just keep doubling your money, right? So if you start out with $100 or with $1, it becomes $2, and $2 becomes 4, and $4 becomes 8. See how simple it is? Go ahead and let's see what's next. And so let's just extrapolate this all the way out, and believe it or not, in just 20 times. If you want to do this, say, double it every year, then 20 years. You want to do it every month, then 20 months. See, so all you have to do is double your money. If you start with $1, you end up with a little over $1,000,000 just after 20 times. See how simple it is, and we've been making it hard all of our lives. But let's click again and see what happens. So here's what happens. Here's the impact of tax. If you just taxed every one of those profits at only 30%, which is kind of the average for a lot of people are right now, guess what happens to your $1,000,000 at the end of those 20 transactions? You end up with just over $40,000. So tax is significant. And that's why we're talking, right? I'm probably not telling you anything new, but tax is really important. Go ahead, let's see what we got next. So according to Jackson Hewitt, those guys you can drive through and have them do your taxes, Americans spend more money per capita on taxes than on food, clothing, and shelter combined. Go, let's see, click. And why is that? Click again. Because the hardest thing in the world to understand is income tax, and that's Albert Einstein, and I'm not trying to claim I'm smarter than him, so click. Because here's part of the reason why, right? The Gettysburg Address, 269 words. The Declaration of Independence, 1,337 words. The Bible, 773,000 words. You think that's a lot? Well, the last version of the tax, and actually this isn't even the last version of the tax code because it doesn't even have all the healthcare stuff in it. So it's over 7 million words. And that's, we started at 11,400. So Congress is talking about tax simplification, right? Every time they simplified it, we've added, a few 100,000 words for each simplification we've done. So I'm kind of betting we're going to hit 10 million soon. I don't know if anybody wants to join me on that. Let's click.
Might be worth investing in a speed reading course for that one, huh?
There you go, at least for me. And here's an example, right? Here's a great example of why taxes are so hard to understand. And this is just straight out of the tax code. And at subpart 17 here, let's say husband and wife. Used in section 52B4, 682, and 2516, if the husband and wife therein referred to are divorced, whenever appropriate to the meaning of such section, the term wife shall read former wife, and the term husband shall read former husband. Sounds good so far. And if the payments described in such section are made or on the behalf of the wife or former wife to the husband or former husband instead of vice versa, wherever appropriate to the meaning of such section, the terms husband shall be read as wife and the term wife shall be read as husband. And we wonder why we have issues with gender mix-up now. But, so I didn't mean to go there, but and you, at first glance, you're going to look at this and say, this is crazy. Am I a husband as my wife? And a lot of people will stop right here and say, you know what? The tax code, it's just, so I'm going to let somebody else handle it. I'm not going to even bother with it. But let's take a big, deep breath and say, you know what? It's really not that complicated. And let's just read it again and see what it has to say. Really, all it's saying is if instead of the husband making the payments, the wife's making the payments, then we just flip the terms around. And it could have said that really simply, but we don't have professional writers writing this stuff. We have professional politicians writing this stuff. So it comes out all convoluted like this. But let's not get too... The tax code really isn't all that tough. And you say, Warren, you say that because you do taxes all day long. But really, there's those 7 million words closing in on 10 million words. In your life, there's probably a very small section of those that actually even apply to you. So what I'm trying to say here is don't just look at taxes and say, that's complicated, I don't understand, and leave it as is. Just relax, take a deep breath, and see what you can do to understand it. And that's what I'm here to help you understand it as well. Let's click. So here's the tax formula. As complicated as it can be, right? The tax formula is simply this. right? You take income, you subtract expenses from that, you come up with taxable income, and multiply that by the tax rate, and poof, that's how much tax you pay. All right, that might be overly simplifying it, but let's look at this formula first. Who likes my example of expenses there? You can't see me raising my hand, but I am. So how many things are on there? I'm curious, you can answer this because I can't hear anybody else, but
Uh-huh.
how how many things are on the screen there that affect how much tax you pay? All right,
Well,
knock it off.
I would say just about all of it. I mean,
All
income,
of it.
expenses, and even tax rate. Yeah.
Exactly. And so many people think it's like, well, Congress right now, they're talking about lowering the tax rate. Well, that's a good thing, but that's certainly not the only way to affect our taxes, especially if you have a business or you're doing investing, or both. Both especially, because income isn't just income, right? We can affect when income is going to be taxed sometimes. Maybe it's this year, maybe there's a way we can push it off till next year. Maybe we can look at the type of income, which is going to affect that down to tax rate. But income isn't necessarily just income. And yeah, that sounds like we're making taxes complicated, but that's a good complication. Expenses, we all kind of get expenses, right? You know, the interesting thing about this is, again, when you're an investor or you own a business, expenses comes out after income, right? Take income and you subtract expenses from it. If you're simply just an employee, what happens before you even get your income? The taxes are already taken out. So this way, when you own a business, well, you get your income, then you get to deduct a bunch of things, and then you figure out the income that your taxes are calculated on. Well, what about tax rate? What can we possibly do about tax rates? I mean, isn't the tax rate the tax rate? I mean, that's what they're fighting on in Congress right now. Well, the tax rate isn't necessarily the tax rate. There's a lot of different ones. Well, there's capital gains rates and regular tax. There's also such thing as people in our lives that might be in a different tax bracket than us. And so there's ways that maybe we can move income to a different tax bracket of a different person. And if we don't have another person in our lives, well, we can make one. Well, corporations could be considered a person, right? And so corporations have another tax rate, and we could move income to that tax rate. So there's a lot of options, but the most important thing is that we have a business. And once we have that business or significant investing, we can then start using all three of these pieces and not just be waiting on Congress or somebody else to help us. We can take advantage and start doing things ourselves. And as far as introduction goes, that's the main concept I want. I really don't have more slides for you because I want to just have a nice conversation and and talk about tax and talk about questions that people might have and where you're at and how do we save some money.
Awesome. Well, I know for those that are on, like, go ahead and start typing your questions, whatever you have. Type that in the chat, the little chat bar that's there on in the bottom of the screen. You're definitely welcome to do that. In the meantime, I'm going to ask you some questions, Warren.
Awesome.
We got two groups of clients that are watching this, whether it be live or recorded right now. One, of course, is those that are business owners, small business owners, right? And then the other ones are employees, but these employees are typically looking at doing outside investments, things that are not the typical mutual fund. We're breaking away from the 401k and IRA and that kind of thing. And so let's start with the employees, those that actually are working W-2 type incomes, those that say, hey, what can I do? I mean, I know as a business owner, I could write off a lot of stuff, but what can I do as an employee? What are some things you would teach those people?
Well, when you start doing investments, investments start if we're doing the right kinds of things, and you can ask me what the right kind of things are, but like you say, getting away from the mutual fund and those retail type investments, we start getting into other investments where you have a little bit more control over what's going on. It starts looking, in the tax world anyways, a lot more like a business. And so there's a lot of deductions that are available to business owners that would also be available to you as an investor. And sometimes we want to be careful with using that word investor because sometimes the IRS will look at the word investor and think mutual funds. And so, like for example, I have a lot of people, a lot of clients that are real estate investors. If you asked them what they were, they would say real estate investor. I have to always correct them. No, you have a real estate business. You're not really a real estate investor. And so there's a difference because again, investor sort of implies completely hands off. I got my money in a mutual fund and I'm just going to ride the roller coaster.
Mm.
Um, that's not what we're talking about here. So if you're in real estate, maybe even you're doing some lending, you're doing some things life insurance wise. There's a lot of things that you can do investment wise that start opening up the world of expenses to us. So at least it opens up that one category with the nice car beside it. Uh, Income wise, there's also some options there, or tax rate wise, I really should say, because we're looking at whether it's going to be capital gains, we're looking at whether it's going to be passive, whether it's just regular earned income. So there's options there as well as an investor. So I guess I would drill down further on the particular kinds of investment that we're talking about.
Yeah. Well, let's go with real estate, like you were saying here.
Okay.
Like you mentioned, real estate business, right, which is a key distinction. First off, like this is something you talked to me about as well and confirmed because I'd heard it from somewhere else. But if someone is an employee, I mean, naturally, we know like with passive income, quote unquote passive income, right, that we receive from rent, from homes and things like that, we can only depreciate with depreciation and everything else. We can only depreciate down to zero, correct?
Well, and it's not even just depreciation; it's all expenses. So
Okay.
with passive income, so there's three buckets when it comes to income. And so here's my little snap at tax simplification again. You see, way back, and I'm old enough to remember this, but back when Reagan was president, we had a tax act called tax simplification. And we simplified taxes. And back then, before tax simplification, we had just one kind of income. And so we simplified that into three kinds of income because obviously three is easier than one. And and so there's earned income. Picture these as all buckets. I should have had my bucket slide, but picture three buckets, right? And so the first bucket is earned income. The second bucket is portfolio income, and the third bucket is passive income. So each one of those buckets kind of stands on its own. Earned income is basically what you get from your W-2 or if you have a business. Passive income is when your money works for you. You know, basically you've invested in a business or something like that. You don't really do much. You just put your money in and the money comes back to you. And portfolio income, to us in kind of the wealth building world, we would look at portfolio income and say, well, that's passive income. But two just wasn't simple enough. We had to have three kinds of income. So we created the portfolio income bucket, and that's really paper assets. So it's things like stocks and bonds. So it's dividends and interest and capital gains and those kinds of things. And so they each sit in their own bucket. Passive income includes rental real estate because no matter how much work you do in rental real estate, the government thinks you don't do anything. It's just passive. You have a rental property, you go out to your mailbox and there's a check there once a month. Sometimes you even forget it's that time of the month and all of a sudden there's a check there and you go, "Oh my goodness, I forgot rent was coming in. How great." And you don't it just shows up. It's just a happy day, but that's obviously not what happens when you own a rental
Uh-huh.
property. But that's what basically Congress thinks happens because they, by definition, consider all rental income as passive income. And so when they sit in their own buckets, a loss from one bucket can't bleed over and affect the income from the bucket. So in other words, if you had a rental property that lost money, you couldn't use that loss to reduce your W-2 income, at least not according to the general rule. You would need some other type of passive income, let's say another rental property, or maybe you invested in something else that had an income, and then you would be able to net those guys out, and that's how you would keep everything in that bucket. But let's say your loss is more than income in that bucket. Well, according to the general rule, you get to carry that loss forward to the next year. And then we look again. Oh, do you have any losses or do you have any income we could use these losses against? No? All right, we'll carry it forward again. There's no time limit to how many years you can carry it forward. You can carry it forward basically forever. However, when you sell the property or whatever generated that loss, so there's losses attached to each individual activity you're doing, and when you sell one of those activities or dispose of one of those activities, any unused losses that are attached to it free up that year and you get to deduct them then. So with passive losses, even under the general rule, it's not a matter of will you be able to take them, it's a matter of when you'll be able to take them.
Yeah,
Now,
great.
that's the general rule.
Mhm.
Of course, with real estate, what makes it interesting is there's exceptions to that rule that will allow you to take those losses regardless. And so one of those exceptions is if your income, if you make under $100,000 a year, you can write off up to $25,000 worth of losses against any kind of income.
Hmm.
But as your income gets over 100,000, that 25,000 starts to phase out, and when you get to 150, it's gone entirely.
Mm.
So that one's kind of interesting, but not all that helpful.
Uh-huh.
The better exclusion says if you can qualify as a real estate professional, then you can deduct all of your losses.
Right.
And that's what we really look for. And if you're married filing a joint return, we just need one of you to qualify as a real estate professional, not both of you. In real estate professional, it's not a license or anything like that. It's just a time test. It says that you spend at least 750 hours on real estate related activities during the year, and that's the easy part. The hard part is that you spend more time on real estate than any other income producing activity. So if you are working a full-time job, it's usually what, 2,080 hours a year. You got to spend 2,080 hours and 1 minute on real estate, which gets a little tough.
Hmm.
So often we'll look and find maybe one spouse or the other can qualify as the real estate professional while the other one's got the W-2 job bringing in the money to pay for the real estate. But there's always a way. We're always kind of searching and digging and looking. Those are our main tools. The best thing to know though is let's say you had a rental property that you know you you generate, and we can get into this detail in a little bit. But let's say you had a rental property and it gives you $5,000 a year of income, right? $5,000 positive cash flow. And let's also say that you had $8,000 of depreciation on this property. We can talk about that part later if you like. But for tax purposes, that means we have a $3,000 loss, even though we put $5,000 in the bank. Now, whether or not we can deduct that $3,000 loss right away is a question. But even if you can't deduct it right away, guess what? You still got $5,000 tax free,
Hmm.
which in my book isn't a bad thing.
That's a great thing.
It's a great tax-free money is our favorite kind.
Agree. Okay, so in most of these cases, I would say most clients, not all of them, like some actually would qualify under that 100,000, maybe barely, for the income levels and be able to take some of the losses there. Others are usually at least in a 28 to 33% tax bracket themselves, right? They're usually making at least 100+ thousand a year, usually between 100 to 500,000 a year max, typically. Probably married, filing jointly for the most part. Um, in a situation like that where maybe they are W-2 employee and that sort of thing, and say they do have a non-working spouse they can use. One client actually asked me this last week, and I thought it was a great question, which was, how does the IRS verify that you're working essentially 15 hours a week average, right? That 750 hours per year. How do they verify that?
That's a great question. And first of all, we don't have to give them any details of this with the tax return, right? We just
Huh?
basically claim that status on the tax return. Uh,
Hmm.
and it's just really claimed by how we calculate the passive what we do with the passive losses. There's not even a box you check that says, "Hey, I'm a real estate professional." It's just how you process the return or how you do make the calculations on the return. So the verification would only come if the IRS decided to audit you.
Right.
And and if they did, what they would want to see is some kind of records, some way of establishing, well, where did you come up with this crazy idea that you're a real estate professional?
Hmm.
And what we suggest people do is keep a log of their time, a diary, some kind of a time log that says, hey, today I spent 3 hours doing this, I did 4 hours doing this, and if you are working another job, maybe it's part time or whatever, you also should keep track of the time you spent on your job, so we can show that you spent
Sure.
more time as a real estate professional. The One of the interesting things with the IRS is that in the IRS's rules of evidence, they are not allowed to doubt what's called a contemporaneously generated record. It's hard to say. Contemporaneously generated record. So basically what that means is if it looks like you wrote this down around the time that it happened, they can't say it didn't happen. They might be able to say it doesn't count, but they can't say it didn't happen.
Mm.
And so with these diaries and these records, I'm kind of old school with this. I like to do this by hand, in a little daytimer notebook or whatever. I mean, a lot of people use Microsoft and Outlook calendars and those kind of things, and those are okay, but they really don't show time very well. And so that's why I just like writing it by hand. And a little calendar book gives me an excuse to go to the stationery store once a year, or I guess now I can just do it on Amazon, but get my little book and I just write in there how I spent my time, because it'll definitely show time, right? Because I'm going to grab whatever pen I happen to have laying around. So if you were to look in this thing, it's going to have several different types and colors of ink in there. It's if you knew me very well, I'm sometimes a little bit messy and probably spilled something on it somewhere throughout the year. So it's going to have some kind of stains on it or something. And so if the IRS asks for it, they would look at it. They would go, "Yeah, that definitely looks like he had been keeping that up over time, and he didn't just fill it out the day before we showed up."
Hmm.
But if Excel is all, or if Outlook is all you're willing to do, I'll take that. Whatever it takes to get you to keep track of your time, that's important.
I told one of our clients to use, if she, easy one like I would use is just tracking on my calendar, my Google Calendar, just blocking out that time, when they did stuff. Obviously, I would say even include like just trying to finance a property. The time you spend filling out mortgage paperwork alone sometimes can almost get you qualifying, depending on how much you deal with the underwriting and so forth.
Well, one of the things, however, with what the IRS does is the time your time that counts as towards real estate professional status is your time in a dated day-to-day kind of hands-on real estate business. They would make the distinction between time you spent in that as opposed to things that a mere investor, so back to that word investor, a mere investor would do. So like hey, I was talking to the property manager. Like, well, if it was just a little, how come my property's not rented yet? They would say, well, even an investor would do that. Or,
Hmm.
I deposited the check from the property manager. Well, even an investor would do that. So
Hmm.
we need to take the step beyond and say, these are things that are involved in a day-to-day business,
Hmm.
the hands-on part of the real estate business. And and I talk to a lot of people say, but I have a property manager, and that's a negative side. So the IRS will look at, because I've talked to auditors before on this, and one of the things that might trigger them is say, well, you deducted property management expense. So how in the world can you say you're a real estate professional when you hired a property manager? I was like, well, property manager doesn't do everything.
Hmm.
And one of the things I recommend to people, yeah, I just talked to somebody last week about this. Uh, I recommend if you have a property manager, maybe you don't just sign their standard boilerplate property management agreement. Make it more or less of a co-management agreement where you kind of outline some of the things that you're going to be responsible for and some of the things that they're going to be responsible for.
Right.
And and make sure those things that you say you're responsible for should reasonably add up to at least the 750 hours or the more time than the other. And
Mhm.
and that's very, very strong evidence to the IRS to say, yeah, I have a property manager, but I don't trust him to do everything. I basically do, all these things. And see, it's even in our agreement.
Mhm.
And so you're taking steps beyond what the average person would do. And once the IRS, remember, I don't want to offend people, but the IRS, they're government employees, right? They want to get their job done as quickly and as painlessly to them as possible. And so if they start seeing somebody who's really got their act together, they're not going to spend a whole lot of time pursuing this because there's going to be 30 other people on their list that they need to talk to that haven't done a thing right, and they're easy kins. So the more organized and the more you understand the rules and it looks like you're doing everything you can to comply with them, the less fruitful it looks to them, and hopefully it discourages them enough to spend very little time and move on to the next guy.
What about education and training? So if someone says, "Hey, I want to get training from a conference I go to," and they fly there, which obviously there's travel and so forth, or even just listening to podcasts. Maybe there's not a financial expense there, but still, it's time invested in trying to learn their craft. Would that count?
It's it it's very much on the line, right? And it depends on how detailed the training is. So first, get the training. Is the training deductible? Is a whole other story that's a little bit easier to answer. But the time, I would say, we have to look at what you're learning to do. Are you learning to be a better investor? Then I'd say no, that's things investors would do. Am I learning how to be a better property manager? Am I learning how to approve tenants? Am I learning how to analyze a property? What am I learning to do? Am I learning to do more hands-on day-to-day real estate business stuff, or am I learning more investor stuff?
Right. Basically, are you being the business owner or are you just being the investor, right?
Exactly. And what am I being trained to do in
Uh-huh.
this particular course?
Now, kind of a side question to this. For those that, okay, say they can't qualify, or maybe they can't qualify yet to be a real in the real estate business, right, as a professional. I mean, could they just set up a side business and have that be as a way to create some offset of losses and so forth?
You and we didn't even talk about this in advance. You're like, this is great. Me and you are on the absolute same wavelength with things. So I love that. So one of the things when we work with people and we're doing a tax, we call it tax strategies when we work with people. We'll look at where people are spending money, and sometimes you'll see a pattern of places that they're spending money, and maybe that's a good idea to start a business in that area.
Mm-hmm.
Because if you're spending money there, you probably have some kind of passion there. And not that you have to have a passion to set up a business, but it sure helps.
Mm-hmm.
And with the internet and all those things, let me give you an example. So I had a few different examples here, but I'll give you one. Uh, Client, he had a great business. He had music clips and sound that you could subscribe to. They're royalty free, and you can use them for webinars and videos and your websites and all this stuff. And they're royalty free, copyright free, so you wouldn't get in trouble. YouTube wouldn't kick you out for using it, and and you paid a monthly subscription fee, and you could download and use all that you wanted to. Well, his passion was uh, scuba diving, and we were talking, and we found out he spent a lot of money in scuba diving stuff. And I said, well, you didn't bring that up when we were first talking. He said, well, that's just a passion that I have. It has nothing to do with my business. Like, well, let's think about it. And he had underwater. He was getting underwater camera equipment because once you start scuba diving enough, you want to show everybody else what you've done when you're down there, and looking for sunken treasure or whatever it is. Uh, so I thought, well, what if you added a premium onto your subscription site where people can also download video clips, raw video footage that they could splice into their videos and stuff. So you filmed all this underwater stuff that people can use in their videos because, like me, if I wanted to do something underwater and create a tax video with a treasure chest, I'm not going to go strap on a scuba tank and go down and do it. But I can download that from him with my subscription fee, and now that becomes part of his business. So there's a lot of ways we can look at creating that business. If you are working full time, maybe there is a way to carve out that business piece out of something that you like doing or something that's out there. Another guy, he started a website for showing people how to help their kids get athletic scholarships to college because all of his kids were very, very active in high school sports and even below high school sports and so they spent a lot of time and money with their kids working them, helping them get those scholarships, and they learned a lot and they videoed a lot and so not only were we able to get a lot of those expenses related to what they were doing for their kids to get them a scholarship, but it deducted, but now we created this other side business and it's interesting. Sometimes these guys actually it backfires and they start making a lot of money instead of having big deductions. But
Which isn't the
oh
worst thing in
well,
the world either, I guess, right?
it isn't because just imagine if you've created a business, right, and you were able to deduct a bunch of stuff that you're already paying for right now that you've never deducted before. They're coming out of your pocket, and you were able to deduct all that stuff and you still had money coming in left over. Don't you
Mhm.
just hate when that happens?
That's horrible.
It is. You know,
Yeah, awesome. I love those examples. One question, kind of switching a little bit of gears here, a different scenario, and then I want to get to Jesus's question he asked several minutes ago. But obviously we have people that are business owners too, and I know some aren't, but definitely maybe we're looking at trying to create a side business or something, even if it's the real estate professional business or whatever it might be. We're definitely trying to get them to that point. Tell us a little bit about the whole corporate rent strategy. Where you use your house for one day's usage. That kind of thing. Explain that. Explain the legitimacy behind it and when it works and when it doesn't.
okay. Yeah. So obviously, first we need that business, right? So that
Yeah.
we can have a place for these deductions to go. But there's this thing, and people will sometimes kind of call it the Augusta rule, right, from the Masters golf tournament. Uh,
Uh-huh.
Basically, you're allowed to rent out your house for up to 2 weeks and not have to recognize any of the income from renting out your house. It's kind of this de minimis rule, and where it really goes back to is picture kind of a spectrum, right? Where if you have a property that you rent out, but you also use it for personal use, how do we determine what we get to deduct and what we don't get to deduct? So the IRS looks at the two extremes. They said, for 2 weeks, if you rent it out for 2 weeks or less, we're going to pretend like that didn't even exist. That's just a minimus. You can keep the money. We're not even going to worry about it. And on the other end of the extreme, if you have a property like a vacation rental kind of property, and you have personal use of that property, and you use it for 2 weeks or less per year, we don't have to consider the fact that you had personal use of it. We're still going to deduct all the expenses related to it. So those are the two extremes. They say, you know what, 2 weeks, we're not going to worry about it on either end of the spectrum. And then the middle of the spectrum is where we have to just try to allocate, all right, percentage-wise, how much time was it available for rent compared to how much time did you use it personally? So that's where this rule comes from in an attempt to make things a little bit easier on people that are just doing a little bit of stuff.
Mhm.
Uh, Other people will come back and say, yeah, no, it was all those people in Augusta, Georgia. That's where the 2 weeks came from because people start renting houses about 2 weeks for 2 weeks during the Masters tournament because there's not a lot. Apparently, I've never been to the Masters. It's on the bucket list, but I've never been myself. But yet, uh, apparently, there's not a lot of hotel room. Augusta's not a big town, and this is the only thing they have going on every once in a while, the Masters every year. And so, for people to live, so people to stay there, they rent out people's houses. And the 2 weeks, you rent it out for 2 weeks, probably get top dollar because it's the only thing going on in town, and you don't pick it up as tax. So how do we use that ourselves if we don't live in Augusta?
Right.
Well, if you have a corporation, or it doesn't even have to be a corporation, if you have a business, and let's say you want to have some kind of an activity, you want to have a party, you want to have a retreat, you want to something that you would maybe normally go out and rent a hotel space for, or some other facilities. Well, instead of renting that, what if you rent it your own home, or your business rent it your own home for that sort of thing? Well, then you would get a deduction for the rent in your business. And on the flip side, if you did this for less than 2 weeks, you fit into that de minimis rule and you don't have to pick it up as income. So obviously, again, how do people know? How does this work? Documentation, documentation. And that same rule about contemporaneously generated records counts here too. Maybe even take some photographs if you're using it for like a party or a corporate event. Maybe take some pictures of it to show it really happened. The more stuff you have, the better. And how much are you going to charge? Well, it's fair market. What would you expect to pay for some? If you were to rent the exact same thing from somebody else, your next door neighbor or whatever, somebody you didn't know, how much would they charge you for that? That's fair market value, and that's the amount that you would deduct. And the money really should move. If you're a sole proprietor, it's not a big deal. But if you're a corporation, an S corporation, even a partnership or anything like that, it's really good to actually write the checks and deposit the money, have that money move and come out of the account. You might even invoice yourself for that. Let's get all nerdy about it and document it really well.
Yeah.
But that's a great strategy, and not a lot of people talk about that or do that, but it's out there and completely legitimate as long as you do really do it, right? You can't just pay yourself. Say, hey, my house would be worth I'll make this up, $8,000 to rent for 2 weeks. So every year I'm just going to give myself $8,000 for my company. No, you actually have to have the event. You got to. I mean, doing it otherwise kind of is what ruins it for everybody else. So let's follow the rules and do this all legitimately. There's too many great tax breaks out there for doing things the right way that we don't really need to try to do it the wrong way.
I agree. Yeah, it's interesting. I actually had an experience I think it was 2 years ago, where I had, done this strategy, and it's easy for me in my business because I'm at home all the time anyways. I mean, come on, I have somebody even want to come visit, even if they're a potential client, right, or whatever it might be. It's like, well, cool, that could qualify, and a lot of times there's different uses of it. And so when all was said and done, I reported the numbers, reported as a business expense, as a rental, basically like rent, because for the business that they had to pay. But then on the flip side, like I realized my tax bill, I was like, this looks a little high. And I went back to him. I said, hey, I hope you know that the income coming in as rental income was only for 12 days last year. It wasn't even for 14 or more. It was just 12 days. He's like, oh, well, let me correct that really quick. And he corrected it. And next thing you know, $5,000 tax break. $5,000 difference on my tax bill just from that one little thing, even though I was getting passive income tax on the one end, but now getting it to where there's no income tax at all. It made a big difference. It really did.
It does, and even home office works out really well for a lot of people too. And some people are afraid of home office deduction, and for that, it's got a bad rap. I mean, years and years ago, people say, "Oh, it's a red flag. If you take a home office deduction, you're going to get audited." Well, maybe that was the case years and years ago. I don't know. I won't say my age, but. What's happened though is the IRS has been beat up so many times over home office. Congress put it into the law. IRS would come in and try to create some kind of little stringent thing in order for people to take it, and then either someone would take it to court, and either the court would say, no, IRS, you've gone too far, or they'd even or Congress would come in and clarify the rules for them. And so finally, after being beat up enough, IRS is kind of basically given in on the home office thing. It isn't a red flag, and my proof that it's not a red flag is about, was it about 2 years ago now, maybe three. Uh, the IRS came up with a standard deduction for home office. So they simplified the rules. They made a very simple way to deduct the home office. It's just a flat rate per square foot of home office. It's not a good deduction. It's much better to do the actual one in most cases, but it's just my proof that, hey, the IRS has now made it even simpler to do the home office. So unless you're even more cynical than I am and think the IRS is just trying to trap you, some people probably do, but it's a the home office, if you don't take it, you are truly leaving money on the table. And home office is big, and let me spend if I can, a second on it, because there's more than just what you think with home office. I shouldn't probably even say this, because this is like giving some of the candy away for free here, but this is really good. So home office, it's just kind of fun, right? So you already know, or probably know, with home office, right, we're going to be able to deduct a percentage of all the expenses from our home, uh,
Right.
based on the amount of area that we're using for our office. And we can get into those details at another time. But some of the
Mhm.
other things that people don't consider. So I'm looking at you there, Chris, and you're got a lot of stuff in that room.
Yep.
So when you're sitting there, first thing I tell people is, so sit down, get a piece of paper out, and start writing down everything that's in that room. Because especially when you're just starting off with your business, there's probably a lot of stuff in there that you paid for a while ago that your business didn't pay for. You brought that into the business with you. So,
Right.
if you're sitting down, well, it's probably a good bet that there's a chair. There's probably a desk, there's a computer and a screen and a monitor, and so you think of those kinds of things, right? But look around. Do you have paintings on the wall? Well, there's decor, right? I mean, bookcases and lamps and everything that's in there. Write it down, especially if you haven't paid for it. If your business hadn't paid for it, if it's all stuff that's been there, write it all down and put down what its value is. And this doesn't have to. A ballpark is good enough, right? So basically, just like with the other question, you basically just ask yourself, how much would I have to pay for this if I were to buy it today, considering it's used and whatever condition it's in? Reasonably, how much would I have to pay for it? Write that number down. We're going to deduct that. And if you're in a corporation or something, or any other kind of entity, we'll show that the company owes you the money. If it doesn't have the cash to pay you right now, we'll just put that on the balance sheet that the company owes you some money for that. It basically bought it from you. So you've now sold all of those things to the business. There's no you don't have to pick up a gain on that, because you would have lost money, I'm sure. And so you
Right.
put all that money, you put all that into the business, and we'll start deducting it. So that's one thing with the home office. Another thing with the home office, I turned off my camera because not not having a really good hair day today. So yeah, and, but yeah, the two of them are just out of place. Uh, so if you saw here, outside of the door, the office I'm in right now is not in my home. We rent outside office space because I've got a whole crew of people here working with me, and frankly, I really don't want them in my house. But just kidding. Uh, but if you were to come, you walk out of my office here, and across the hall is a kitchen. In the kitchen, we've got a refrigerator, and we've got coffee maker, and we got bottled water, and if you open the refrigerator, there's a bunch of sodas and snacks, and some of them are even healthy. So we got all that stuff in there. And if you work in my office, you can help yourself to anything that's in there. There's nothing off limits, right? I buy it, it's in there. I do that at my convenience as the employer, because really I want them to be able to grab the food and get back to work, right? I don't want to have to go through and have to unshackle from their chairs and all that stuff so they can go get something. So I'm doing this at my convenience as the employer. Therefore, I'm allowed to deduct all of that. Now, just because you have a home office doesn't mean you can't do the same thing. You just have to follow the same rules. right? So
Right.
what are those rules? Well, one, everybody that works in your home office has to be entitled to anything that is in there. That's probably not a problem for you, Chris. Uh, the other rule is kind of the opposite, right? That only people that work in the office can have those things. That might be a little bit more of a rule. So in order for that to work, right, we have to segregate those out somehow. We have to separate them. In my office right in here, I have my own little refrigerator. You might have a little refrigerator in your own office. That's easy to segregate. But you can also just come apart and here, this part of the pantry is the office stuff, or this shelf is the office stuff. And hey, everybody else in the house, this is Dad's. This is off limits, right? Y'all can't have this. This is for office workers only. And you do that, you can deduct those things. So that's just another little thing. There's several. A home office is just a treasure trove of things to deduct, and it meets my basic rule of not spending money just because it's deductible, but let's look at where you're spending money already and see if we can make it deductible. I mean,
Right.
you've
Awesome.
already you've spent the cash. Let's take credit for it.
Exactly. Cool. Well, I know we only got a couple minutes here, so this is awesome, and I know we can go on for hours
Yeah,
on this,
sorry,
which is good. This is why
sorry.
you guys, all those you guys watching this, this is why you need to set that meeting. You get the end sooner the better because he is booked solid. So let's talk about Jesus's question here, which is an interesting one, which is what is the tax implication of transferring title of a rental property from personal name to a multi-member LLC? This will be
And
for you.
that's a really interesting question because it's a structuring question in it. So if you had just simply a property in your own name and you had
Oh,
let's say a three
keep
person
talking,
LL.
Warren. We can't hear you.
Oh, hello?
Oh, there we
Can you
go.
hear me now? Okay,
Uh-huh.
sorry. I got too excited and I waved my arms around and it killed everything. Right. So if you have a property and you own it entirely yourself, and you already have an LLC set up that has, let's say, you and two other people in it. And so that's basically what the question says. And you were to take that property and put it in there, somehow those other people are benefiting from you putting that property in there, right?
Mm, right.
if if we treat it just as a partnership, and let's say the property is worth $100,000, and let's say everybody has contributed, everybody we set up the LLC, everybody put in $100. So that means everyone's capital account in that LLC is $100. And now I take the property and I transfer that property into the LLC.
Mm,
My cap count is now $101,000, while everybody else is $100. So there's several ways that this works itself out. One is that my my percentage of ownership in that LLC is now huge compared to everybody else's because I contributed $100,000 more than everybody else. And if we calculate my percentage of ownership based on my capital account, that's what would happen. If we gave somebody a larger interest than that, then there's the potential of that being some kind of taxable gift or income to that person. Depending upon why we say, well, he's going to be the property management and do all the work. All right, well, you just gave him something of value for doing work. That sounds like you paid him, and that now is income to him.
mhm.
Uh, I I gave them that because they're my child and I love them. Okay, now that is a gift, and we've got to look at the gift rules about that. So if instead we structured it where and I guess we'd have to really look at the circumstances of why you're doing it and what you want to achieve by this whole thing. Jesus, so if you had a an LLC that owned the property first and then you brought in two other members, that could kind of change the dynamic a little bit. But still, we're going to have to deal with the fact that those capital accounts aren't even unless we want it to be that way. Uh, there's special rules for, and this isn't what you asked exactly, but there are special rules for, let's say you have a property that you paid $100,000 for, but now it's worth $300,000. And you have investors who came in and they're all putting in $300,000 each, and instead of you putting in $300,000, you're going to put in your property worth $300,000. So technically you're all even, except your basis in that property was only $100,000. So what the rules say we need to do is we need to allocate expenses and deductions away from you towards them until we balance that differential out. You still get credit for being 300,000, but your basis is only 100, so we have to work on equalizing that basis by allocating deductions around over time. And so uh, we're kind of a little bit along those lines. But I would certainly welcome you to give me a call, Jesus, and we just need to figure out what you're trying to achieve, because there might be a better way to achieve that, or a less taxing way to achieve it.
Sure. Great. Awesome. Yeah. Again, like everybody, it's always case by case. So, and not to mention, I mean, and I'll just tell this as a word of warning, you guys, as a disclaimer, is that hey, we've got Congress right now, we got politicians right now trying to do the whole tax reform currently. So a lot of these things could change, in just the next few months, and this is why you want to be actively involved with your CPA. So, Warren, thank you so much for your time today. This has been awesome. If people want to get a hold of you, obviously I'm already connecting you guys anyways, but if somebody here watching this wants to get a hold of you, what's your contact info? What's the best way they can do that?
The best way, so our email address, and this goes to my assistant who basically runs my life, it's info at tacpas.com. Should probably put it on the screen, but so it's info at tacpas.com, TACPAS. There you go. Somebody here is technically skilled.
Yeah, I'm using my fingers. Not very
Or if
well
you
though.
wanted, if you wanted to call us, you could do that as well. It's area code 480-948-9510. And another really good suggestion is check out our Facebook page. Our firm is called, we're Taryle Accounting. So you can find us on Facebook, and we, especially with the tax law changes that are maybe possibly hopefully coming up. I used to trust politicians, and then I gave up on that for a while ago. So I mean, some of the changes they're talking about are very phenomenal, and we'll be very, very excited to see them. But I kind of don't believe that they're going to do it anymore. But we're staying right on top of it. Wednesday they're supposed to announce what it's actually going to look like, because they're going to start voting on it. So we'll be paying a lot of close attention on Wednesday, and the first thing we'll do is put things as we learn them, as we come up with strategies to react to what they're doing. They'll be on Facebook, so that's the best place to go, is follow us on Facebook and just keep up to date.
Awesome. Well, definitely, we gotta be proactive with that. So thank you so much for this. This has been amazing, absolutely amazing. I know this is great stuff for me personally, as well as anybody else watching this. So, Warren, thank you again, and everybody else, thank you for joining us. Those you watching the recording, hey, don't bother typing questions because you can't. So enjoy. Again, take action. Reach out to Warren if you've got questions. So everybody, thank you so much, and we'll talk to you later.